You mentioned the movements you're expecting to see in the precious metal markets, and you also mentioned how a lot of the big banks are often, what we see on the COT report, often very net short. Now, we have been talking about on this channel that has been shifting over the last few months as banks are becoming less and less short, and my understanding is they might actually be going net long. I could be misinterpreting that, but your perspective on how it seems like from the COT report, we're seeing a huge shift of the smart money actually moving towards the long side.
Well, look at the derivatives market. 99% of the derivatives market is never going to take delivery. It's just a perpetual churn, decade after decade, year after year, extend and pretend, extend and pretend. And the BIS, which is the central bank to the central banks, has basically unloaded the vast majority of its swaps. And then as that was being unloaded by the BMS and Basel III and all that was going on, you suddenly see in the US, Citibank and JP Morgan owning 90% of the derivatives book. And to your question, I think the notional value of their derivatives trade has gone up 500% this year. So they are deep into the derivatives market to try and price fix gold. In the meantime, a lot of players in that market now want physical delivery, when we all know that the distance and the notional value from the actual physical amount of gold to the amount of derivatives being traded for delivery is fantastical. Again, but there are players now asking for delivery. And that is an interesting, compelling shift, that now physical gold is more interesting than paper gold, which is a complete fantasy. And I think the cynical realist in me knows that banks like Citi and JP Morgan aren't going to allow their shorts to unwind until they've covered their backs, until they've got enough physical gold. And right now they're repressing the gold market intentionally to hoard more of the same so they can slowly take delivery of physical gold and build up their gold reserves as much as they can. And then they'll let the price rip higher. There's no doubt that that's one of the reasons the Moscow standard is coming in, the Moscow world standard is coming in, because the LBMA banks and the large commercial banks in the US and in Europe have completely embarrassed natural price discovery in physical gold. And so, again, all these things are happening at once and slowly, but they are eventually unfolding. I don't see a scenario where gold gets weaker in the next 5 to 3 years as everything is falling apart, as countries are moving away from the dollar, as Eastern Bloc countries and BRIC countries are looking for other ways to buy physical gold and to market physical gold in a new exchange. This is outside the LBMA market. And also just to see even countries like Saudi Arabia, which is theoretically an ally to the US, it's a strange ally, they're now looking to do their own gold refineries within their own borders. So there is a larger and larger amount of attention towards physical gold, less and less credibility in the COMEX market and the COMEX trade of the paper gold. It is the open secret that has become the open farce. It is harder and harder to hide. And now you have this Moscow New World Standard. So many things are happening. Again, this is slow, but it's kind of like Hemingway's definition of poverty. It starts off slowly, then happens all at once. There's going to be so much changes right now. It's impossible to time them. It's impossible to even price them, but the trend is inevitable. Currencies are being devalued. Countries are going into recession. Credibility of central banks is downgrading or dying. Citizens are getting more and more angry. Wealth disparity is increasing. And the world is moving more towards physical gold, from transactions between Turkey to Brazil to South America to now in Eastern Europe. So I can't see how this isn't a massive tailwind for physical gold owners. And again, most gold owners are patient. They're not traders. They're not looking at the COMEX price. They're looking at history and they're looking at basic economics. And they're seeing a recession coming. And again, the recession, dove or hawk, whether Powell thinks he's Paul Volcker or not, rates are going to have to come down, and the QE is going to have to start again, and the dollar is going to have to get weaker. So gold is going to love this recession. I don't see any way out of it. And I think the idea of a mild recession, again, if I were a Fed chairman, maybe I'd have to say that to keep the troops or the team happy. I think even Powell knows this is not going to be a mild recession. And that's not doom and gloom. It's just, again, it's not even politics. It's economics. It's sad math.
In your article, you mentioned the transition from the petrodollar standard to the petrogold standard. So if we start seeing countries actually using gold in trade, it seems like the effect that having the dollar as the world reserve currency, how it boosts the value of the dollar. We're seeing a lot of people move into the dollar for safety right now. We're seeing, as we mentioned, the dollar at multi-decade highs. As we see that transition from people seeing, okay, we want to trade, countries saying, okay, we want to trade in dollars, to, okay, we want to trade in gold. I mean, then that same effect is going to be transitioned to the gold price. So it seems like that should just be incredibly bullish for gold.
Absolutely. Again, take the small example of Turkey. And, it's not the most robust economy or currency or the lira in the world. You talk about horses in the glue factory, but Turkey's realistic and they're tired of importing America's exported inflation, and they're tired of paying oil in dollars. And what they did, again, is they sold dollars so that they could buy gold, so that they could give that gold to Russia to buy rubles to get oil. So that's effectively a new gold standard and an oil price. It's just a small example of Turkey effectively using gold to buy oil. And I think as the Moscow gold standard increases and as more countries are effectively using gold to buy oil, again, the oil market's 12 to 15 times the size of the physical gold market. Even a small change in using gold to buy oil is going to dramatically impact the price of physical gold. Then it will be interesting to see how the West looks at Western gold versus Eastern gold and what legislation comes into kind of tweak the reality of that. But I can't see a scenario where physical gold demand doesn't rise as countries like Russia and China and the BRICS in general, and even smaller countries in Eastern blocs are moving away from the dollar and using gold to buy energy. And it started early this year, and it's only going to continue. Even if there was a peace settlement tomorrow with the Ukraine and Russia and the West, Moscow and Beijing are never going to forget what happened to those FX reserves to Putin. Again, not pro-Putin. I'm not supporting them. Frankly, I'm kind of agnostic. I think it was an avoidable war, but not to laud Putin. But I think he's playing chess while the West has been playing checkers here, and they're never going to trust Western neutral currencies again. So there is going to be between the Eastern Bloc and the BRICS, even in South America and South Africa to Eastern Europe, there's going to be a shift towards new currency, a new currency basket, and certainly towards more gold for oil, which will be dramatically powerful tailwind for the gold price, regardless of the COMEX price fixing that we've seen for decades.
How will this impact the silver price?
Again, the silver price right now, when gold rips, silver will rip faster, and it will rip at a different multiple. What's really, I think, hurting silver more than anything, and not just the derivatives market or the futures market, what's really hurting silver the most, in my opinion, is the strong dollar. Because as you said, right now, it's hitting record highs. And it's what I would do too. I mean, Powell and Biden and Larry Summers got together and decided to make the dollar stronger, raise rates to attract foreign money into these markets as we're fighting this cold financial war with Russia. And, and basically invited a lot of suckers into U.S. markets which have been getting hit. But that strong dollar is not sustainable. It's not a sustainable policy. And so, but that means gold or silver's boot to the neck of silver is not sustainable either. And if anything, it's the best value opportunity than all times right now to accumulate silver at these prices. It's very hard to be a contrarian, but I think if you step back and look at history, what its lessons are, and if you look at the tailwinds to where the future's headed, it's pretty inevitable that we're heading into a recession, that the world is going to be in pain, including China and Russia too. They're not, tiptoeing through the tulips, but there's seismic shifts in currencies and there's seismic shifts in oil and gold markets. And so when the dollar does get weaker and gold starts to take off, because even as gold lost $50 as the dollar got stronger, but even gold's loss is nothing compared to other currencies relative to the dollar. So it's still a more stable monetary metal than most of the other currencies in the world. And right now, it's just biding its time for when this dollar policy is no longer sustainable. And then when that dollar really starts to reap what it sowed and become even more devalued in a recession, silver will be one of the better instruments to own at that point. And I think for patient investors who've been, biting their knuckles and biting their nails and buying silver at these lows are actually going to get the last laugh. And I don't know when that's going to be, whether it's a month from now, 6 months from now, but most precious metal investors are playing the long game, not the putting green. They're playing the long drive. So, I'm excited for them and for the rest of us that have thought 5 years, 3 years ahead as opposed to 3 weeks.